Thanks for joining us for this month's educational video. Today we're going to be breaking down one of the most common questions we get from clients, which is what account should I invest my money into? RRSP, TFSA, or FHSA? Today, Kevin and Alex are going to break down the differences between each account and when it might be best to use each one.
So let's get started with the Registered Retirement Savings Plan, or the RRSP. So as the name suggests, this account is predominantly used to save for your retirement. And one of the big benefits of this account is that your contributions into it are tax deductible against your income, meaning that every dollar you contribute reduces your taxable income. So for example, if you earn, say, $100,000 a year and you make a $10,000 RRSP contribution, you then reduce your taxable income to $90,000. So getting that tax break is the main purpose for contributing to the RRSP. And so for that reason, we really ideally recommend this account for people who are in a 28% tax bracket or higher, meaning you earn at least $60,000 a year, basically. The reason for that is if you earn less than that and you're in a lower than 28% tax bracket, there's really not much further lower you can go. And so saving to that vehicle doesn't make as much sense for you. The other thing to consider is that all the money you contribute and all the growth on this account is only tax deferred, meaning that when you withdraw the money, ideally in retirement, that money is taxable income to you. So we want to try to get a tax bracket differential here, meaning we want you contributing to this account when you're in a higher tax bracket in your earning years, and hopefully in a lower tax bracket once you retire, when you take that money back out again. So that also means that if you're a couple, a married couple, and you're both trying to save towards your retirement, if one of you is below that 28% tax bracket, one of you is above, it doesn't make sense for both of you to be contributing to your RRSP. There's other accounts that maybe make sense for the lower income earner, which we'll discuss further in this video. In that type of scenario, it might make sense for the higher income earning spouse to contribute to a spousal RRSP, which gives them the tax deduction, but the account is in the lower income earner's name, meaning when they retire and they withdraw the funds, it's in that lower tax bracket. So this account is really good for retirement planning, for tax management, but ideally this is a long-term investment vehicle.
So now let's talk about the tax-free savings account, or the TFSA. Despite the name, the tax-free savings account is not just a traditional savings account like you might have at the bank. You're able to hold stocks, bonds, ETFs, mutual funds, a wide variety of investments within the account. Now, the main benefit of the tax-free savings account is the overall flexibility that it provides for you. Any money that you contribute to this account, as well as all of the growth that you earn on those investments, you can withdraw tax-free at any time. So say you're planning for an upcoming vacation or a vehicle, or you want to have your emergency expenses in this tax-free savings account. If you ever needed to access those funds, you'd be able to withdraw that, whatever amount you needed, tax-free. So let's say, for example, you contribute $50,000 to a tax-free savings account, and over the years that investment grows up to $100,000. You're able to withdraw up to or all of that $100,000 tax-free. Now, the tax-free savings account has an annual contribution limit. And when you withdraw from the account, you lose that contribution room in the year of the withdrawal. However, you gain all that room back again the next year. So if you withdrew that full $100,000 in, say, December of one year, in January of the next year, you're able to put a full $100,000 back into the account. Now, the flexibility is really where this account becomes useful, but there's also some long-term planning implications that come from this account as well. Because like we mentioned, any income that you're pulling is tax-free. It doesn't appear on your tax return. This can be very useful for things like long-term care planning, where we want to keep your income relatively low, your taxable income relatively low, in order to reduce your overall care costs for long-term care. It can also be useful for things like vacations, emergencies, or a new vehicle like we mentioned.
The newest account of the three is the First Home Savings Account, or FHSA, which was created to help Canadians save for their first home. Now, this account comes with some contribution limits. The $8,000 is your annual contribution limit, up to a maximum of $40,000 lifetime contribution limit. So if you contribute $8,000 a year, you can contribute for 5 years until the account is considered full. Now, this account combines the best parts of the RRSP and the TFSA together in one account. So the $8,000, or the amount that you contribute into the account, gives you a tax deduction against your income in that year. Now, any growth on the money in the account is tax-free. So it grows tax-free, and when you withdraw the funds, as long as you do so to buy a home, a qualifying home, then all of that money is given back to you tax-free. So getting that contribution in your, maybe for a younger Canadian, when you don't need the RRSP contributions, you get the tax deduction without using up your RRSP contribution room, which can then be saved and utilized in your higher income earning years. So the First Home Savings Account is a great account for Canadians who qualify to save for your first home efficiently.
So now that you know more about these three registered account types, you're probably wondering which one is the right one for me. And like David mentioned, all three of these accounts work together and they depend on your personal situation, your goals, and your financial plan. So a common example that we see from our clients here is if you don't already own your first home, we want you to prioritize that First Home Savings Account, using up that contribution room for your tax deductions, as well as working towards that $40,000 lifetime limit. If you already own a home, the RSP then becomes a great way to start saving for retirement while also receiving those tax deductions. But like Kevin mentioned, you want to prioritize these contributions when you're in your higher earning years above that 28% tax bracket. Any unused RSP contribution room carries forward into the next year. So you can save up that room until you're in your mid to late career when you're really starting to earn more money. Finally, we have the tax-free savings account, which is great for providing flexible money for something like a trip, a vehicle purchase, an emergency fund, or even saving for retirement to start having some tax-free income available for you then. At the end of the day, these accounts work together and they're designed to work together. We don't want to focus on one account over any other accounts. They work symbiotically, and you want to save to all three depending on your own goals.
Thanks, guys. That was great. The key takeaway is clearly that RRSPs, TFSAs, and FHSAs are not competing accounts. They all serve different purposes, and which one you should prioritize saving to depends on your income, your goals, your stage in life, and your individual financial plan. As always, if you have any questions about which one might be right for you, we'd be happy to hear from you and happy to walk you through it.